Investors in Europe are faced with a painful Hobson's choice. Parking money in the supposedly safest assets, such as cash or government debt, is likely to result in a zero or even negative return over the medium term. At the same time, riskier options, such as equities or real estate, are exposed to a fragile European economy and look far from cheap. On Wednesday, the European Central Bank made this dilemma yet more complicated by starting to buy up corporate debt. Negative yields, which are now common across many government bond markets, will now become a growing headache for investors in bonds issued by European companies. So in sifting through this ugly contest of riskier assets offering ever-decreasing returns, where should the sensible investor be putting their money today? The emergence of a new mega buyer of corporate bonds in the form of the ECB is creating a compelling divergence between the debt and the equity of companies with strong balance sheets and robust business models. Northern Trust Securities has observed that the yield on certain bonds issued by France's LVMH have turned negative. At the same time, the shares in the handbag to champagne company trade on a forward free cash flow yield of over 5%. LVMH is one of a number of European companies that Northern Trust classes as high quality, based on their proven ability to compound earnings over time. LVMH has achieved an average return on invested capital over 5 years of 11%. Crudely put, this means that the company makes 11 cents for every euro it invests into its business. Shares in these companies do not come cheap. LVMH trades at a forward price to earnings ratio of around 20 times. Inditex, the Spanish fast fashion chain, has achieved a staggering annual return on invested capital of 28% over 5 years, but costs a princely 29 times forward earnings to anyone who wants to buy its shares. Paying such lofty multiples could be seen as a risk. But a company that compounds its earnings over time will more than reward anyone who pays a rich price today. Conversely, those who choose the option of negative yields and plan on holding to maturity are actually guaranteeing a loss of capital. Smart investors should recognize which will be the better choice.